Hello everyone, today is November 12th and this is our session number 10 of the Wyckoff Practicum course. What are we going to do today? As usual, we're going to go through a variety of things and then we're going to conclude our exercise that we started last time on the selection. So I'm really happy that, that exercise produces some kind of questions. I would be surprised if we wouldn't have questions about that. That would mean that you guys are not paying full attention to this, and maybe I'm not emphasizing enough what process we go through with this exercise. So today, let's have a little bit more focus on that. So I want to go through everything of what we have really fast to get to the exercise, and then we'll finish. I also want to talk a little bit about the markets today, just in general. Okay, let me just see one thing. Hold on a second. Okay, I think I got it. All right. Okay, so yeah, I want to talk a little bit about the markets. I think they're in a very interesting spot. I think this is where we're going to see some kind of reaction. So I want to, get your thoughts on that and kind of like discuss it, see what we see. All right, with this, let's start. As always, everything that we talk about in this class is for educational purposes only. Let's talk about the bias game first. This was a very interesting one, and I think that we had 50-50 on this one last time, right? When I asked you guys, what do you see here? A distribution or an accumulation? I think the class divided into 50-50, and then obviously I'm receiving all of the homeworks that you guys send. I go through all of them, so sometimes if I don't reply, like today I was a little bit busy, but I did go through all of them. And if there was a question, I definitely inserted it into the deck. Why was it difficult? For those of you who did not, guess this correctly, could we maybe, and do we know the bias here? Yeah, the bias is to the upside. It's a reaccumulation. So for those of you who said that it was a distribution, what was the difficulty? Or maybe even for those of you who said that it was reaccumulation, what was the most difficult part to identify that would help you out with the bias? I want to start with that today. Okay, we're kind of gonna back engineer a little bit. So write it down, please. What was the most difficult part of the analysis for this bias game? Lower highs, lower lows. Okay, what else? So kind of like a structure itself, a little bit downsloping. Anything else, guys? The second rally that failed to achieve the new high. Okay, so a lower high, downslope. The last three bars were the most difficult. Okay, this increase of the supply, and then we have a reaction. Anything else? Because we could just, address this three and I would be really happy about this. Let's just do that. Okay, so let's look at the overall structure. A downsloping structure, would you agree? Yes, absolutely. And then if you kind of think about the ways of how a linear regression channel would behave on this chart. Let's think about this just for a second. So on the way up, we definitely would have that channel representing the trend line, and then the mean is going to be somewhere here. Then there is a second portion of this chart that is going down here before we have the rally, right? So we probably would have then the regression channel like this. Then obviously there's going to be something, to the upside as a trend of the upswing is up. And then this last portion, if you take, let's say, this part right here and include the previous reaction, then you're probably looking at something like this at that point. So you could see that this trading range that is, up there to the right is actually residing on the resistance, and now it acts as a support of the trading range before. So you have kind of like that stepping stone and a stepping stone, but both are down sloping. And I think that could be the difficulty here, because on the top of this, you also have this lower high. So the rally, even though this is the largest rally that we see here, the question that we ask, did it commit to the upside? And I think that, here we could go different ways about it. We could definitely say that no, it did not, and it failed, just because we're looking for that buying climax, resistance overcoming, committing above that. But at the same time, we might say, okay, well, we do have also the downslope and the whole range, and this is probably phase C at that point of time. And did we actually commit to the upside? Above the downsloping resistance, yes. Not only that, we actually spent quite a lot of time above that resistance. I'm going to draw this again. Look at how much time we are spending, not just above, but we are actually going up. So I have this term, progressive close. So how did that come about? Progressive. Why is it a progressive close? Again, not from the methodology. Because you have on upthrusts temporary commitments that go above, let's say, and there is no commitment even there, the close was here, but imagine that this was the close. So you have a temporary commitment above and then an instant comeback below the resistance point. Here we have progressive closes. What does it mean? We have closes that are committing above the level of resistance that are defined for them to, to commit. So we're using that significant bar methodology here. So these 3 bars are definitely committing above the resistance, and then each and one of them commits also locally. Then the next bar that will have the same type of commitment is going to be this one, maybe this one, this one, and I'm not sure about this too, because the close is at the bottom, probably this one, but not the last one. So we could see that throughout this time that the price spent above the resistance, it had 1, 2, 3, 4, 5, 6, 7, 8, 9 progressive closes. That tells you that the duration with which the price spends above the resistance on the major sign of strength is significant enough for us to confirm that the bias is to the upside. And obviously that comes very easy when you use the downsloping resistance, right? What about the fact that, no, okay, why don't we just use what we usually would use, a horizontal resistance? And I think we should rightfully do so, something like this. So then how would we analyze this trading range? Okay, well, probably we're going to come back to the analysis, from the left a little bit later. let's address the last 3 bars or the last 4 bars. And I think actually, yeah, actually, let's conduct the whole analysis because that would lead right into why we're thinking, about these 3 bars in a specific way. So we have a leadership stock, demand is very healthy, and we are not suspecting any distribution on the way up. Look at how volume signature expands, but it doesn't really expand to the climactic size. This is probably more climactic rather than, let's say, this. This probably shows more that demand is less or there is a fewer demand for this stock. And we could see this also in the momentum itself. Look at how these 2 rallies are behaving. There is a lot of momentum, there is a lot of aggression, and then the last 2 actually have only momentum maybe on the initial kickoff bar, and there is nothing after that. So we're seeing that demand is going down. Demand is fading. And that suggests that we are going to have some kind of reaction. But still, at this point of time, there is nothing climactic about a stop in action. Even though this is a buying climax and this is a stop in action, there is nothing climactic in the way of the terminal culmination of the uptrend. The bias at this point is going to be still to the upside. Now, our next task is to see what kind of change of character we're going to see. And by the way, we could label it slightly differently. We could do the labeling of the shakeout, automatic rally, and then secondary test. And that would conclude phase A. In a way, sometimes that's how I just label it for myself. This is just the area where you have 2 stops. You have actually 2 trends. One trend, and I'll gladly confuse you here, guys, because you are more advanced than WTC students. There is a trend to the upside, actually much more than that, and then there is a trend to the downside. Both of them have to be stopped. So it makes a lot of logical sense for me in this type of situations to think about shakeout, selling climax, especially when the move has that type of finishing touch, like a climactic touch or a shakeout touch with a lot of volume signature and a big spread. So therefore, sometimes I kind of label it both scenarios on the same chart. Does that make sense? And that defines both stopping actions in the testing for both of the trends, up and down. You guys see that? And then we are kind of done with that action, and then everything else we have that is B. So, okay, so what could we conclude from phase A? We were waiting for some kind of character of this first reaction, a change of character reaction. Volume definitely comes, but is this the highest volume signature? Is this the highest supply? Probably not. There was more supply here, actually, than let's say here. The last bar, and let me just clean this up. The last bar contained a lot of demand behind it. We could see that from the demand tail. Look where the price has closed. It almost came back to, 1/2 of the last move. So that was a very strong intraday move, suggested that there is a lot of demand right there. And then the next day, there is a lot of effort to push the price down, but it doesn't go down. So this is effort versus result. There is a lot of effort, no result, bullish. We're still up here. We are testing, and test happens on some increase in the volume signature, but creates a slightly higher low, so we're still encountering some demand. Bias is still up. Weak rally. This is where weak hands see in value. They bought in, and this is what drives this rally. But we also recognize that through this buying that we see here and then here, somebody actually significant bought in this position. Why? Well, because look at this whole rally and look at where we are in terms of giving up the space and profitability of the previous upswing trade. We are probably retracing 1/3, no more. And then at this 1/3, we're encountering a lot of demand. There is also demand in these bars right here. And that's where people are buying on the upside. So this is the value zone where they're buying. We want to define that. Everything above that is going to be overbought. Everything below that is going to be oversold. Once for the first time we come to that oversold condition, there is a stopping action. Another time we're trying to go down, another stopping attempt. So is there progression to the downside when there is this attempt to push the price down and there is an opposite force that stops that move, from further going down? Yes. So demand is there. Demand is present again. Now result to the downside slightly expands, suggesting that we are still in the upward bias, but supply is present, and therefore duration is going to increase. We go further, investigating the next couple of reactions. This one also has demand behind it. There is some demand off the low, kind of like a false start. And then after that, we see how on the last two reactions, supply actually goes much lower. And demand goes lower again. Both supply goes low and demand goes lower. We could see this from these volume spikes. General deterioration of the volume signature, suggesting that whatever selling we have had and attempts to break to the downside through the support, all of that was consumed. So we have two areas of institutional consumption of shares, absorption. We have area number 2 and we have area number 1. So far, we are all on the upside, and we're seeing that there is definitely a value buying at the lows. We don't see a significant momentum buying on the way up, and that's why it looks like a weak rally. Question: why? Why are they not buying on the upside? What do you think, guys? If there is something missing in this picture, it's that momentum signature, right? That we would usually have in phase D. Okay, the pump in action July-September is confusing. July-September. Okay, we'll go through this again. They all bought in the value zone. That's the key. Simon got it. We would expect ITFs to be jumping in right here. Yes. So that's what's so interesting. It's almost like momentum players are not present, right? So value bought in. So this is long-term value. Therefore, contrarian. This is the same. Long-term value, contrarian. No momentum players. So I was thinking, why would this happen? And where is that momentum? So we definitely see a lot of momentum on prior advance. And we see how momentum actually diminishes going into this last bar right here, into this last leg. And that tells us that this is where momentum bars were present, and then most likely they're the ones who gave up those shares. This volume signature right here is the rotation between momentum hands and value hands. Momentum hands are saying, okay, well, this price went relatively fast. We don't want to participate anymore. We're going to take some profit. And the value, when they see that it's not that even that the short-term value is available, but the value investors need large positions, so they need liquidity. And they get this liquidity on the profit taken by the momentum traders on exiting those positions. So then the story kind of becomes a little bit more logical in the sense of, what we see from the value bars in two zones here, and then also in terms of this rally not being a very big momentum rally. Momentum traders probably will need to see the break above these highs first, and then they will start participating again. Okay, well then, if value here is inactive, momentum players inactive, and then weak hands are probably out at this point because they are exhausted with all of the losses that were brought up to them in the last 4 or 5 months. Then we see that generally that would lead to the lower volume signature, something like this. But throughout this volume signature, we could see very definitive trend. When you look at the days to the downside relative to the days to the upside, you could see that demand is still dominates the supply, either with consistency of many days in a row, or just even visually, in terms of how much supply, how much demand comes. So it looks bullish, this rally. And we understand what's happening behind that rally with the weak volume signature. So then the bias is still to the upside, but we are saying that if we're going to have some kind of failure, then we're going to reconsider and negate that bias. All right, well, let's look now at the last portion of this chart. We have had two major reactions, and then we are having the third one. If we would look at swings and would consider, let's say, the volume or the effort that it takes to move those swings to the downside, we definitely would see that the effort to the downside generally is diminishing into the third reaction. And then when we would look at the result, we would probably say that the result to the downside also diminished. Bullish or bearish? Bullish. But let's approach this in a different way. That was too easy. Look at the character with which the price moves and how the volume behaves. We have supply coming in, increase of the supply. There is some selling that happens, but then there is a stopping almost instantly, and there are multiple attempts to go up again before the price falls again on increased volume signature, but we see some demand on this bar, and there are two attempts to rally again. The progress of that commitment is very minimal. There is only one bar that commits to the downside, and then the price recovers really quickly. Next time, we have the same type of, how would I describe this? Not impressive commitment to the downside. And with that also the down spread is diminishing as well. And that happens now on the diminished effort signature. So we're seeing how the strength of the push is deteriorating, and the result because of that is deteriorating as well. Suddenly some demand comes in, and then we have that ominous 3 or 4 days to the downside where supply is increasing. What is the commitment to the downside? One close, we have a tail off the low, and we have the highest volume signature out of those 3 days, suggesting that there is some demand behind it. So there is quite a lot of effort that is increasing just locally, not to be compared with this too, but locally. Let's say from this area right here to this, definitely there is an increase in the effort to push the price down, and yet the character with which the price goes down and the actual result is minimal. The bias is still bullish. So as we have gone through this whole chart, the bias really has not changed anywhere. I always think about, those points of vulnerability. Like for instance, yesterday I tweeted out, I was looking at the intraday picture and the daily for both actually, for oil and for the market. There was something wrong about that, the behavior, of how the price was behaving. We're going to look at that, and in a second. There was a point of vulnerability, and we're still in that point of vulnerability, I think, with the markets. Doesn't mean long term, it's just a short term. There is some selling that comes in, and it has to be resolved somehow. So it's after what looked like a weak rally. This is the moment of vulnerability where selling is coming in, and we need to see what kind of behavior we're going to see here. Is it going to be more conducive to bullish picture or more to bearish picture? And that's our bias game. Let me quickly go through the solution here. Let's look at what has happened afterwards. We have a big bar like this. And by the way, guys, would I give you this bar? Would all of you say that this is a bullish bias? Would you say so? If I would give you that one more extra bar, would you say that instead of, let's say, a distribution or distribution, you would go for the bullish bias? And that's why this bar will never make its place into the bias game, because the challenge for this game, I think, should be in the Wyckoff story that unfolds throughout the whole chart, rather than just like, one catalyst at the end. There was one student who asked me, to do exactly that, to have that type of reversal, swing reversal, and I said, no, of course not. There's no fun in that. Okay, so how does the price moves after that? We kind of see in a lot of absorption of the supply here. So it happened in 3 places. Here, here, then here. Then we naturally should feel at this point the ease of movement. Why? Because, well, a lot of supply has been absorbed by this time. And also on the top of that, we should finally start seeing momentum players coming back into this position. This has been a leading stock, and now it changed its behavior, and it starts showing some elements of the momentum, especially on this first bar, and then on the subsequent moves. And look how flat this reaction is. One of the things that are important to understand with reactions is the angle or the slope of the price. Once it becomes more horizontal, so we need kind of like this slope to go from more vertically down. I don't know how to draw this. Okay, so from more vertically down to more horizontal. And when we have this, that's when we could say that supply has a specific character. And this character is such that suggests that supply has been exhausted. What we could expect from here is not only continuation, but then also acceleration at some point. Maybe Johnny the Cache can, come up with the scan for us to catch this type of reaction. Vertical reaction, less vertical reaction, and then the slope is just horizontal, something like that. Okay, let's go to a question from Simon. I like this whole analysis. I mean, I like the process of the analysis. It's very tedious, but if you do just one exercise per week, it's worth it. So, Simon, obviously, commending you on that. Conclusion, as we see, was not, a successful conclusion. And let's figure out where we went wrong. And Simon, let me know. Write it down. Let's go to the first question. I interpret B28, 29, 31 as bind by the CO. Is this correct? All right. And this is easier, to go to those bars once you have all of them labeled. Okay, 28, 29, and 31. Yes, and we went through that. Absolutely. So I'm not going to go through the explanation because we just did. All right, second question. With the rally with falling volume, how do we identify an ease of movement to the upside versus the weak rally? And I think that we've done that too. Simon, I think we've covered that, right? So let's not stay on this. Simon is saying, I had in mind that it was accumulation, but second guessed my analysis when we got to RA16. All right, where is that? Where is RA16? In phase D. Okay, right here. Okay, so what's weak rally, weak hands rally? Okay. I think that we could make a mistake here. I think that it would be okay. What do you do with the weak rally? You basically want to have some kind of confirmation that, this weak rally leads to a bearish action. So that's how we would avoid this mistake, or that's how we could possibly avoid this mistake, right? So thinking about what does the weak rally mean? Well, the weak rally means that either the bullish pattern is going to fall, or this weak rally is just going to be a part of the reaccumulation. So you need to go here and to figure out what that weak rally actually meant. And initially, you probably will be thinking, yeah, there is definitely supply that is coming in. But what kind of supply? Not as much. What kind of result? Not as much. Subsequent supply, a lot of effort, not a lot of result. Less effort, kind of even less result. Lots of effort, not a lot of result. So it seems that if we would just say the weak rally needs to be confirmed, then, obviously that could be the way to go away from this mistake. Okay, great. I saw a lot of gap into the downside, and that made me think more distribution. Yes, that's true. Lots of gaps here, but at the same time, what do these gaps produce? It gaps down to the previous support, and it gaps down to the previous support. And the distance, of travel there are not that impressive, just relative to the whole structure. All right, let's go to the next bias game. Here it is. I'm gonna let you look at this for maybe 15, 20 seconds and then write down what do you guys think this is. Is this a reaccumulation or is this a distribution? I'm going through this myself in my mind. All right, let's see the answers. So we have about 60% of you saying this is a reaccumulation, probably around 65, maybe even 70. A couple of you are saying this is a distribution. A few of you, more than a couple. Okay. Well, let's see what it's going to be. There are certain things here that right away catch my eye. I wonder if you see those. All right, guys. As usual, this will come out tomorrow on our Twitter, and then on Friday you could see the solution. If you have not done your analysis of this exercise before Friday, please don't look at Twitter. Do the exercise first and then look at Twitter if you like. All right, let's go to the next question. Actually, let's go to this right away. Ronnie is asking a question. In this instrument, I have earlier look at this as two separate ranges, but I'm thinking they are both part of the larger upsloping range. And that's why we're coming to this larger structure. It's easy to see the structure from away, kind of like see a larger structure, than just like zooming in into the last upthrust or something like this. My reasoning for this is that despite the gap in July, this one right here, there hasn't been a clear change of behavior in the price structure until this last push to the top. Am I seeing this correctly, or am I looking at a very large backing up action? Both. I have also added its relative strength compared to the index. So let's just deal with the relative strength. It's a leader right away. I wonder against what, against the industry group. We're probably looking maybe like against peers. I'm not sure. And what is the structure here? Uptrend, lots of capitulation, but lots of buying as well. Supply is exhausted. There is buying here. So in this area right here, this is our value zone. So anything below, when it comes into contact with a lot of liquidity, is going to be bought. Okay, something like that. This as well. And then on this bar right here, we're jumping up, and this is where supply comes and it stops, produces the first initial reaction, first test, and then still there is some absorption, and now at the higher level. Then we have some buying here. So the bias looks bullish. It's just that we need to overcome this area, and we can't because of this supply right here. So therefore, your bias still should be to the upside, and you should be thinking that unless this upthrust is going to fail in such way that is going to show some weakness, something like this, then I'm still thinking that this is a reaccumulation. And supply at this point has been just, pretty high. It was here as well. So therefore, it might take even several times, to try and to have this type of attempt to get away from this area. And therefore, that could suggest slight continuation of the duration, of this range. And that's how I would be thinking about this picture until it shows me something of the distributive character, where the price commits to the below support in the way how I've shown to you on the sign of weakness. There is a rally that follows, that decline, and it's weak. And then there is a breakdown to the downside in the way of the capitulation. Until I see that, I'm thinking bullish here, and I'm just thinking, let me see if there is an opportune time to come in into this position. In a way, just slightly reminds me of AMD. For those of you who are in WMD, you guys know that I had a position in AMD. And I said that, I see a lot of great patterns here, analogs with the past, suggesting that we're going to have a very big rally in AMD. And my position was opened here. So in a way, I'm kind of making somewhat of the same mistake. I'm just basically going with an idea that, well, this is the stock that I'm going to hold on for some time. So there is no really reason for me to, try to be fancy here and try to enter somewhere later. Maybe we're just going to have one test and then we're going to go up from here. So I entered it there. I knew that because of this supply right here, that we had also it here, we're going to have some duration for this range. Look at the next time we have that increase of the supply. Again, we need to test. And only when we are successfully passing this area, this becomes a true breakout. So very similar in that way pattern. And we have to think about this latest action as increased supply and the big question mark. What's going to happen next? Can it consolidate at this level and then go up? Very bullish. Or more supply, would it go even lower? And then the question is going to be how's the structure being labeled after that. All right, great. Thank you, Ronnie. Let's look at the markets really quick. So there is obviously something that is being talked about probably everywhere, on the technical analysis front, and that is we don't have a lot of volume behind the move. Well, we know for sure that we could definitely travel without a lot of volume signature. We don't have to have increasing volume signature to travel with the ease of movement where the price actually commits above. And that's what producing this, a lot of angst right now among technical analysts and traders, that, this is a fake breakout. But yet, look how it broke out and how many progressive closes we have. Maybe not this ones. 1, 2, 3, 4, 5. 5 closes. The price spends a lot of time above that breakout. So that's very encouraging in itself. Secondly, takes less effort to do what? To push the price out and to actually stay above the resistance. So that tells us that supply is exhausted. Why is it exhausted? Well, because it was all observed here first, then here, everything on the way down, then a little bit here, and probably here too. Then again, on the way down, a lot of liquidity. Here, all of this. This is all buying. And then again here, so now that we've visualized where they bought, so obviously what are they buying? They're buying value, or they are buying by valued investors, by value investors. By the way, this is such an interesting conversation that we constantly have with Bruce on WMD. So buying value, who's buying value? Value investors are buying value. That's why value was outperforming all this time. So look at the levels of the buying and the supply. So supply plus demand, right? Supply plus demand. Supply plus demand. We kind of see that there is a deterioration of that availability of the supply. Less supply available, and it takes less demand to push the price up from high to low. So we see how effort to the downside deteriorates throughout these three reactions because of that value buying. And that's the thing. I think that the mistake that the analysts are making right now, calling this a fake, is because momentum traders are not in this market. There are not a lot of stocks actually that the momentum stocks that are running away really, really hot. So you have to be extremely selective. A lot of them kind of like don't have that steam behind them. So therefore, there is no that a growth element. It will come later on in the later stages of this rally, and there is more buying as the price goes down. So what does it mean with the most current picture? Well, we see some kind of trading range on the intraday level, some kind of deterioration where we might be thinking, okay, well, we have to look into that. And then we also saw where momentum stopped, where the buying stopped. This was the last rally. This is where it stopped at 3,000. This is where it stopped before. So you kind of could see what I'm implying here, and here is that first value zone. This is going to be an extreme for this reaction. So I think that if we are going to have the reaction, we're going to have the reaction not because it's a distribution and supply is present or was present. No, it's a reaccumulation. It's because demand is exhausted. And therefore, we naturally will have some kind of reaction. Unless big news come, very bullish news, and then we have something like this, like a climactic run. So then on the bullish news, we probably would have something like this. Actually, supply is not that great here either. So again, suggest a continuation. But if we're going to go down here, then most likely we would probably go to the 3,000 area. That would be a really good area for us to fall. That would scare some weak hands. They're going to start selling. That lust, increased supply would increase temporarily, would be observed. by value investors. And after that, on the next breakout, this is where momentum players are going to come, and they're going to be extremely aggressive, and they will push this market up, up, up. So when we look at the more recent range on the hourly, so here you kind of could see that maybe this last bar right here after this up thrust is slightly misbehaving, but in reality we still need to break, a very large kind of like picture. There are quite a few spots that look the same, so we need to break that to the downside, and we're seeing an increase in effort, an attempt. So let's see how that's going to happen, or if that's going to happen. Right? Look at this latest bar right here today. That's a change of character bar, but it has to be followed on the downside with for other bars, and we still don't have that. We don't see that. Would it be fair to say that the flat volume results in price momentum falling as we see price spreads narrow and price is starting to mushroom over? Yes, and this is something that we actually covering in this November special. I talk a lot about the momentum, how it looks, how we could identify it. This November special is the prelude to the October special that we've already done with John. And it just explains step by step how momentum should look on the failure or on the continuation, on the confirmation. So if you're interested, sign up for that. We still have 2 classes to go. I'm very excited about that. All right, and I think that's it. All right, well, let's see what's going to happen. I mean, we're just kind of like seeing, some deterioration in the some exhaustion in the demand, and then we're seeing some deterioration in the structure. We're still not seeing a lot of supply, but also at the same time, look how the Dow is also, consolidating. How Russell has not been going up. We're seeing gold starting to have smaller spread, less effort to the downside, suggesting a rally, which would mean that the market could be, in jeopardy here. Oil as well. And this is, the comment about oil, because you guys know that I follow oil almost each day. This was the rally that kind of spooked me. And then this, I started thinking, there is something wrong here. Look at the effort to push the price up. There is a really good rally after that initial consumption of supply. We're not necessarily making the higher high, but we are making 2 closes above. And then the next time the rally comes exactly to this point again. So that shows us some kind of limit as to where the price could rally. And then it did it again. So right here, I went on the Twitter and said that this is a point of vulnerability. It's either going to break to the downside or it's going to break, continue with the move to the upside. So, and it seemed like in the morning, yeah, it might continue, but then look how supply comes in and we are damaging the structure right here. So it looks to me that we are going to have some kind of reaction. So we'll have to see. All right, that's it for the markets. Where are we? 4 o'clock. Okay, great. Good timing. Let's go to the next question. This is something that we will be covering in this Thursday in the November special, but because this question was originally from the practicum, and I promised you guys, we're going to cover some of it here. I think it's a fascinating subject. because my mind was thinking about this for quite some time, and I'm still thinking about this, contemplating, what it is, what is it? How do we measure those two things? And we're talking about the price velocity against the price momentum. What are those? And how do we see this? So from just different sources on the momentum and the price velocity. Momentum is the rate of acceleration of securities price of volume. There is a momentum with which volume can accelerate as well. That is the speed at which the price is changing. And I think this is where, that confusion comes. Speed and velocity, kind of the same thing. And therefore, from this type of the definition, you might be somewhat confused. At least I am. Simply put, it refers to the rate of change on price momentum for a particular asset and is usually defined as a rate. This I understand. This is easy for me to understand. I understand that there is a rate of change. I understand also that there could be a different rate of change. So we could have like a rate of change on the rate of change, and that would define, the velocity itself. But, we can't say that the momentum is just that, rate of change on the rate of change. It's just a rate of change of the price on this specific taken period. Momentum is analogous to a train, and I love that definition, so let's just go through this. Analogous to a train, thereby the train slowly accelerates when it starts moving, right? But during the ride, the train stops accelerating. So think about this. Here is our train. I'm not such a big kind of like guy, to draw all of this stuff, but okay. So at the beginning, when we start our movement, what happens with velocity and the momentum? Momentum starts to increase, but gradually. Velocity also starts to increase, but gradually as well. Then when the train, let's say, gets to, let's say, 60 miles per hour, what happens then? Velocity stays the same, right? It's at 60 miles per hour. So it's kind of like it went up and then it stays the same. But then what do you think, guys, happens with the momentum here at this point? Is momentum increasing or decreasing? What do you think happens at the 60 miles per hour? And, let's say that this is the speed with which the train travels at that point of time. Let me actually kind of like send a curveball to one of you. Hey, John, are you there? John Iscan? You want to unmute yourself? You want to chat about this a little bit?
Sure, I'm in.
What do you think happens with the momentum when the train gets to 60 miles per hour and velocity stays that way?
Well, hopefully it doesn't crash.
Well, for sure.
Well, momentum at that point had to increase to get to that speed, and then it may stay constant at that higher level.
I would say definitely it should increase first, right? Because we are pushing the train and momentum starts to accelerate to get us to the velocity of 60 miles per hour.
Right.
From there, and on the chart, we're going to see it like this, right? But then after that, we hit that 60 miles per hour. We don't need to have any more momentum to stay there. Velocity kind of can stay at that point. So momentum will start to actually decelerate. It starts stopping accelerating. We could see, and there's going to be like a zero acceleration, constant velocity at 60 and zero acceleration. And John, I was thinking about this, on the chart. Let me just bring this really quickly.
Yeah, that is one of the tricky things about momentum, is that it can decrease while price is still increasing. It's just a slower rate.
Exactly.
Increase. Well, very tricky, but it's the case.
Yeah, it is the case, because once that velocity has been gained, it's almost like the velocity is defined by the presence of the momentum traders themselves and their activity in the market, because they're providing that, push with their buying and selling. So we could see that, for instance, let's say right here on, let me just go to the specific period here. And this is something that we will be covering in this Thursday. So I want you guys to think about, if you're not there, you definitely should be there. Let me actually take another period. Okay, so for instance, let's just look at this latest run. This is a good example. And John, please correct me if I'm wrong. So we have a momentum to the upside, and then another wave that overcomes that previous momentum right here. And look at where it stops. It actually stops before the previous low. So there is some divergence right there. And this is something to think about on its own. But then what happens next? The price still goes up, and yet momentum goes down. So it's almost like there is enough acceleration right here for the price to keep the same velocity, and there is no need for any more buying. Why? Well, because at this point, all of this momentum buys together with some stopping action reflect what? Buying. First buying on the way down, and now buying on the way up. So supply is so exhausted that it leads to what we are saying to be a weak rally, or where demand is actually exhausted. Usually this type of weak rally is going to have the reaction into the zone where momentum has stopped going up, somewhere here. So then look at where we land with that. And if we have that, highest value zone area right here, then we could apply the structure and say, okay, well, at specific spots, we want to be extremely more aggressive, like here. John, what am I missing here on the velocity and momentum?
I don't think you're missing anything. It's just a fascinating subject when you modulate the length of time that you're looking at the rate of change. Shorter term, medium term, long term, and combining them together can really give a phenomenal picture of how price moves. In fact, that would be maybe a topic for November special, is looking at multi-time rate of change.
This Thursday, we're going to look into multi-time frame rate of changes, like 3 rate of changes here. I was more even referring to the swing structure, right? So for instance, the low, and we have first push, second push, and then where the second push has like this highest rate of acceleration. And it makes a lot of sense, because when the train starts, to go, the
Hmm.
most acceleration is going to be like at that, not necessarily the first steps, right? So there's going to be like initial push. It's almost like the value investors are absorbing the weight of the train. And then as they start moving, it's much easier to move once the train moves, right? So once they consume that, that initial weight, and then the first big push. And then after that, all other pushes are kind of smaller, right? So the swing ends here. And if we would take this as one swing and we would be thinking, okay, well, let's look at this short-term momentum picture. This is where acceleration has ended. And then there are just some pushes, additional pushes, but they are much smaller. Acceleration there is lower. And yet, look at how the price moves. So we need to understand this concept on a much, much deeper level. Well, John, I'm looking forward to Thursday.
Great. See you then.
Yeah, and we're looking forward to maybe like a scan or two from Johnny Scan.
Well, we've got one queued up, and we're going to work with that one inside and out,
Mm-hmm.
and see how small
Excellent.
changes in rate of change affect the outcome of our scans. Very, very fascinating stuff.
Well, I can't wait. I can't wait. Thank you, John.
All righty.
Kind of
Bye-bye.
put you on a hot seat here. All right. So that was a good question. Okay. Well, Simon, good questions, but let's just probably move on from this and then let's keep this in the November special. But this was a question that I was addressing in my mind for a couple of years now. And I think this is probably the first more serious thought because we are studying momentum a lot lately.